how do you put money into your property company? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. When we set up a company, we have an empty company and there tends to be nothing in it. So how do we go about starting to trade? Well, the first thing we need to do is put some money into the company. Now, this could be done in various formats. For example, if you're providing some sort of coaching or some sort of service like that, then you're going to start getting an actual income into the business. So that's putting money into the company. However, with property investment, we probably need some investment into our company to be able to go out and put a deposit down on our first house. So let's have a look at a couple of the options that we have available to getting money into the company and what the tax and accounting implications are in regards to that. Now, the first one to mention is potentially if you're just putting money in yourself. So you're a director or shareholder of the company and you've got some money in your savings account, maybe an ISA or something that's probably getting not an awful lot of interest these days. So you decide that you're going to put that into the company. Now, it's quite a simple process really. You just literally transfer the money from your account into the company bank account and you've now got a director's loan account or a shareholder loan account. So from an accounting point of view, in essence, you just have money that's owed back to you and that will sit on your balance sheet in your company accounts until you take that money back. Now check out the video on taking money out of your company, which will explain what the tax implications are on taking out your director's loan account. Now, some other ways of getting money into your company, we have a few. Now, we've talked director's loan accounts and shareholders loan accounts, and as you can see, there's not really a lot to it. The main thing is moving the money around. Now, in terms of other ways, it may be an intercompany loan account. Now, an intercompany loan account is where you've got potentially another company that is generating some income and you don't really want to be taking that money out of that company because then you are going to be taxed. And again, if you need to find out how to take money out of a company, check out the video on that. But if you don't want to have to deal with all the tax consequences of taking money out of your company, then you can transfer that money from one company bank account to another and in essence create an intercompany loan account. Now that intercompany loan can be at a specified interest rate or a specified fee, but it doesn't have to be. It could just be a 0% interest-free loan that you do between your companies. That is up to you. Obviously, there are tax consequences if you are charging interest between your two companies because one company will get it as a tax allowable expense and the other will pay tax on the income that it is receiving for the interest that it is being paid, whether it is actually physically paid or not. Now, this again is a loan and that will sit on your balance sheet as an intercompany loan in your company. And it will sit as a loan on the original company as well. So you've just got a loan on both sides, one showing that it's owed and the other showing that it is expecting it back. This is a great way of structuring things if you have a very profitable business that you're not necessarily wanting to take all your money out of, but you are wanting to invest in property, and it's a way of moving your money around to get the money where you want it to be able to do the investments you want to do. There may be scope that you want to have a group of companies, and check out the video on groups to see whether you do actually want a holding company as well as your other trading company and your property company. Now let's have a look at a few other methods, and one of them to mention is investor loans. Investor loans may just literally be as simple as private investor loans, and they give the company money and arrange a loan agreement with them. Now, in all cases, we would definitely recommend that you have some sort of formal paperwork in place, whether it be a family relation, a family friend, or a third party who is of no connection to you whatsoever. Now, whatever you do take in, you would take the money, put it into the company bank account, and then set up your loan agreement, which has whatever arrangements in place that you decide. I'm not a solicitor, I can't tell you what you need to include in that loan agreement, but there's plenty out there to help you with that sort of arrangement. And please do speak to a solicitor to get a more formal agreement written up to make sure that it all complies with the law. The main reason, if anything goes wrong, then you're both protected by that loan agreement to make sure that whatever was agreed is followed through. Now, once that money's in the company, you then have your funds in place to make your investments. For dealing with the money that you pay out to your investors or private loan holders, then please do check out the CT61 or interest payments video to find out what the tax implications are of paying interest out of your company to your investors. And that will explain how it works for you as well as for the individual. Now, these are all the main methods that I have seen recently in putting money into your company. So hopefully that just gives you an idea of the simplicity of putting it in and how it fits together. Check out the videos on the CT61s, which will explain how the interest is dealt with for any investors. And check out how you, as a director or shareholder, can take the money out of the company as well, so that you're not just finding your money gets stuck in a company. You want to be able to take it back when you want it to go and enjoy your life as well. For those that want a little simple accounting knowledge here, what we will do for your money that you put in is we'll credit whatever loan account there is. So that would be your intercompany loan account, it would be your director's loan account, your shareholders loan account, or the investor's loan account, and they would sit on your balance sheet as a credit in any trial balance or any other reports that you do for your software. The other side is a debit, and this debit will go to the cash account because this is going into your bank account and it will sit in your bank until you spend that money. So hopefully that just finishes the picture of what will happen from an accounting point of view with the money that you put into your company. Hopefully today you've discovered how to put money into your company and what it really means. If you have any comments, please do leave one. Please like the video and subscribe to the channel, and let's make tax less taxing. Let's make tax less taxing.